Hi everyone, it's Rich Warner from wealthmaxbuilder.com. This is lesson 2 from the video tutorial series called Essentials of Investing. Today's lesson is entitled, You Don't Need a Financial Advisor, Actually. We'll discuss several reasons why it may be in your best interest to take control of your personal finances and your investments personally, rather than paying a financial advisor to do them for you. Considering the hefty fees that financial advisors charge, on top of the already built-in expense fees associated with many of the funds inside an asset allocation, these added expenses really pile on and cut into your returns. On a long-term basis, the damage can be significant. We'll explore this in this chapter. Please take a moment to have a look at the copyright notice and the disclaimer statement. You can pause the video if you so choose. Thank you very much. Financial advisors can charge anywhere from 35, 50, 75, up to % of assets under management. This is a significant expense fee when you consider that you have to add that on top of the expense fees that are charged for the mutual funds or the ETFs that comprise your investment portfolio. The added expenses really add up fast and really cut into your total returns, especially over the long haul. Take a moment to consider this fact. If your annual returns are 6.5% versus 7.5% a year inside a Roth IRA due to the added expense fees that your financial advisor charges, over a 40-year period of compounding, you would forego over $200,000 for having to pay that extra 1% in fees. Now, where is that $200,000 going to? Well, it's not ending up in your Roth IRA, that's for sure. Indeed, having to pay these unnecessary management fees on top of the expense fees for mutual funds and ETFs is another major reason why most individuals underperform the benchmarks in their investment portfolios. Another reason why FAs may not be worth their while is that most of them, if not all of them, seem to echo and implement the prevailing wisdom of the investment community, which, as I've mentioned in earlier videos, is way off base as far as over allocating individual investors to stocks as opposed to investment-grade bonds. If you explore the many risk tolerance surveys and the asset allocation processes that are prevalent among these wirehouse and brokerage firms, you'll find that most of them consider a moderate portfolio to be comprised of 50% equities and the rest spread out across investment-grade bonds, REITs, commodity-sensitive funds, and cash. So you end up with an asset allocation that is way off the mark as far as optimizing reward to risk. The financial advisory community, supported by such modern portfolio theorists as William Sharpe, Eugene Fama, French, and Markowitz, are basically promoting this concept of overexposure to equities. As you can see here, the green line, which represents the S&P 500, outperforms every other asset class over very long periods of time. This is a chart that goes back to 1925. And so we've got a very long-term perspective here, over 90 years in fact. What you can see from this chart is that stocks, the green line, while they outperform every other asset class, they're among the most volatile. It is one of the most jagged of these lines on this chart. The only more volatile asset classes here on this chart are leveraged real estate, which means that if you buy real estate with a mortgage, and the CRB index, which is the commodity index. So stocks are extremely volatile. In practice, what this means is that if you're an individual investor and you're heavily weighted to stocks, then you have to sit through extremely trying times such as these when there are pullbacks in the market, such as we've experienced during the tech bubble burst, 2000-2002, and then the financial meltdown of 2008. 73-74 was also a rough time in the markets. And then the biggest one, of course, was during the Great Depression when the stock market was down a cumulative 85%. This means that if you had purchased $100,000 of stocks in 1928, by 1932, your investments would be worth only $15,000. This is the type of risk that stocks are subject to. Combine this with the fact that the Dalbar study has clearly shown that individual investors don't have the wherewithal or the fortitude to withstand such pullbacks in the market, and you come up with the conclusion that an overallocation to stocks is simply not a viable option for most individual investors. Here's a table that summarizes the nominal and real returns of the various asset classes mentioned in the previous graph. As you can see from this table, while the stock market gives you the highest average annual percent returns, you're subjected to about 4 times as much volatility as the bond index. And as we've mentioned, the worst cumulative drawdown was about 85% during the Great Depression. It seems that the modern portfolio theorists and financial advisors and the prevailing wisdom of the investment community seems to overlook this dark period in investment history, namely the Great Depression, when the drawdowns and the pullbacks were extreme. But how should we expect the average financial advisor to know this fact or to think contrary to the prevailing wisdom of the investment community? Financial advisors don't get paid to think outside the box, but to stay within the guidelines of firm policies. Let's explore some of the pros and cons of hiring a financial advisor. Among the pros are that financial advisors are all certified professionals. You can't get hired by a brokerage firm today unless you pass a series of exams, including the Series 7, the Series 65 or 66 for fee-based programs. Many brokerage firms also ask you to pass insurance exams to get state licenses to sell annuities. And they also strongly recommend that their financial advisors get certifications from these optional boards such as the CFP. CFP stands for Certified Financial Planner. And if you're going to hire a financial advisor, then you should definitely hire one that has the CFP designation. Another plus with financial advisors is that they can provide their clients with in-house research, performance and tax reporting, various personal financial planning strategy newsletters that are written by some very competent research analysts. Some brokerage firms also provide legal and tax planning advice, estate planning advice, but this comes at higher levels of expenses. So this would be at the higher expense fee brackets, such as the 1% a year level. Another plus of financial advisors is that they can hold your hand during these bear market, tumultuous, volatile periods. Many financial advisors sort of pride themselves on their ability to communicate well with their clients. You know, during these volatile periods in the market, sometimes you need somebody to sort of like reassure you, to stay the course and just stick with the investment strategy. Unless, of course, this financial advisor is churning your account and moving you in and out of funds and stocks. At that point, you should change your financial advisor immediately. Financial advisors can also help you rebalance your investment portfolio, which most investors can do themselves today. I show you how to rebalance the Wealth Max Builder portfolio in Lesson 10, for example. You can certainly do this on your own. You don't need a financial advisor to do this. However, in certain circumstances, especially let's say if you're a senior and you're drawing down your retirement portfolio to pay for monthly living expenses, a financial advisor can help you rebalance on a monthly basis because that could be rather tedious. Having said that, Fidelity Investments, which is one of the top brokerage firms that I recommend, offers individual investors an automatic rebalancing program. So you could tell Fidelity, for example, please liquidate my retirement portfolio by $4,500 a month. Then Fidelity will actually go in there and liquidate the portfolio in this example by $4,500 and then restore the asset allocation weightings for you automatically. So you don't need a financial advisor to do that either in that case. Now let's explore some of the cons of hiring a financial advisor. First, of course, are the fees. This can range anywhere from 35 basis points for the lower tier service levels to as high as 1.25% for the extensive financial planning, estate planning, tax advice, and legal advice planning that some of these brokerage firms offer. Again, keep in mind that this is on top of the expense fees that the mutual funds and the ETFs charge inside your asset allocation portfolio. So in effect, you're looking at a net cost of at least 1.25% if you go for a middle tier financial advisory service. Another major negative, in my opinion, is that financial advisors are not fund managers first. They are salesmen and great communicators, but they're not really great quantitative analysts or portfolio managers per se. They don't have a CFA designation, for example. They don't have certified financial analyst designation. They have a certified planning designation in most cases. That's an important difference. And as I mentioned in previous videos, the risk tolerance surveys that they implement on behalf of their clients tend to direct clients to overly weighted portfolios with stocks as opposed to investment grade bonds. I find that these risk tolerance surveys in this regard, as well as their psycho-emotional evaluative gauges that they use, I find that these risk tolerance surveys are not always useful because in most cases you end up with a portfolio that is overly weighted to stocks relative to investment grade bonds. It is no secret that when you're hired at a brokerage firm, that you're pressured into gathering as many assets as you can. They're saying to their FAs, go out there and gather as many assets as you can from as many people you can network with. So FAs are great networkers and communicators, but they're not portfolio managers. This is a very important concept, and many folks out there seem to ignore this fact. I once came across an FA who bragged to me that he had over 2,500 accounts under management. Well, the immediate thought that came to mind was, how do you service 2,500 clients in a year? As a financial advisor, you're supposed to meet with your clients at least once a year. So if you have 2,500 clients and there are only 365 days in a year, well then you're going to have to schedule 7 meetings per day every single day of the year. Well, yes, this financial advisor did have an assistant or 2, but that's about it. Even with an assistant, it's very difficult to meet with all these clients and do the correct due diligence and the services that you're supposed to provide for them. In these meetings, you're supposed to review any changes in the familial status of your household, see if there are any changes in financial goals, review tax planning strategies, as well as the overall investment performance with your client. How can you do that if you have so many clients? So there seems to be an emphasis on asset gathering rather than in portfolio management at these brokerage firms. As mentioned in previous videos, I also find that the risk tolerance surveys that FAs implement with their clients to point them in a direction that is overly weighted to stocks relative to investment grade bonds. And this really adds risk for individuals that in most cases they're really not able to take. Another con with FAs is that they're often to push sales products on their clients. So even though they say they're fee-based, which means that they get charged a flat percentage of assets under management per client, they will inevitably try to stick in a sales product like an annuity where they get a commission from a sale. Sometimes FAs will also promote bonds and mutual funds and fund families that are going through the syndications of some of the wirehouses, or they happen to be in bed with particular fund families. This often results in your being placed into mutual funds that have much higher expense fees than the generic ETFs or low-cost generic benchmark index funds that are available at Vanguard, for example. Finally, not all FAs have the CFP designation. If you're going to go with an FA, make sure that they at least have the CFP designation under their belt, in addition to the required certifications that I mentioned earlier. Now you have these robo-advisory websites that at least provide some consistency for individual investors at somewhat lower fees than FAs. But the problem with these robo-advisory websites is that they too point investors into overly stock-heavy weighted portfolios. I visited some of these robo-advisory websites, and I found that after having taken some of the risk tolerance surveys just as an experiment, that just like the financial advisory community, assume that a moderate balanced portfolio is comprised of 50% stocks or thereabouts, which again is overly weighting investors to riskier assets. At the root of the problem with these risk tolerance surveys, in my opinion, is this fixation with the concept of the green line being the best performing asset class and completely ignoring the volatility of the benchmark stock index. You end up being placed in an asset allocation that is very weighted to stocks as opposed to investment grade bonds. There are good risk tolerance surveys and there are not so good risk tolerance surveys. Some of the better risk tolerance surveys I've found focus on quantitative factors as opposed to qualitative variables. Let's take a look at some of the quantitative factors that I believe are important when you're doing an asset allocation for an investor. Among the important quantitative factors are a client's age and their time horizon. Because you don't want to be allocating a senior, say, at the start of their retirement heavily to stocks when they're starting to draw down their portfolios and live off of their retirement nest egg, and then you go through this bear market. That could severely cut the lifespan of the portfolio for that senior. You don't want to be anywhere near 50% moderate portfolio at the start of your retirement especially. Another serious quantitative factor to consider is a client's net worth. And net worth is simply the aggregation or sum of all your assets relative to all your liabilities. What you own minus what you owe. And the difference between the two, assets minus liabilities, is your net worth. So if you have a high net worth, you can afford to take a little bit more risk than someone who doesn't. Not much more, but at least a little bit more. And you should factor that into the mix also. Then there's average annual net income, which is very important because especially as you approach retirement, you want to know whether or not you can hold off taking Social Security benefits. If you have a solid investment income going into retirement and perhaps even extending into your late 60s, then you can hold off on taking Social Security benefits and allow your investment portfolio to grow some more. These are very important concepts in the asset allocation planning process. Then there's your health and longevity. If you have some sort of prognosis that requires continuous medical attention, or you need very expensive prescription medicine or therapy, then of course these additional medical expenses will cut into your net income and also factor in how much you need to draw down your portfolio during retirement. Very healthy individuals, for example, not only have low expenses, but can expect to live longer. And so if you expect to live longer, well then you're going to have to make sure that you have enough in your retirement nest egg to help you go the distance. This is an important reason why you should not be heavily weighted to equities again, because if you have a severe bear market, you could severely cut the value of your nest egg. Finally, another important quantitative factor is the number of dependents you have. This is especially relevant for early to mid-career investors. If you're saving for a child's education, for example, you don't want to be overly weighted to stocks because you want the money to be there in 18 years to help pay for a college or vocational technical education. Among the qualitative variables that I find to be next to useless and should not be part of an asset allocation risk tolerance survey, in my opinion, are these questions that are related to emotional reaction to market volatility. Like, how would you feel if the market gave up 50% of its value in a year? Would you be able to withstand this type of market risk? And these psychological feelings about certain investments come to mind also, which if you're a benchmark index investor, which you should be, are really not that relevant. Another useless qualitative variable that you find in some of these risk tolerance surveys is the expected returns from the market, as if to say that the individual investor has a say in how much the markets are going to return on a year-to-year basis, which is totally off the mark. The markets do what they want to do, regardless of what Mr. and Mrs. Jones should expect to take from the markets on an annual basis. As mentioned earlier, a good risk tolerance survey should point you in the right direction as far as asset allocation is concerned. The alternative is that you go with the WealthMax Builder program, which will give you an optimal mix to begin with, so you don't really need a risk tolerance survey, as I mentioned in Lesson 10 of this course. I'd like to briefly mention another area of interest, which are target date funds. There are a lot of these retirement target date funds, and what these target date funds do is that as you approach your retirement, they begin to scale down the allocation to equities or stock funds in the overall mix. So the allocation to stocks by these major target date fund programs, and I've explored several from Vanguard, Schwab, Fidelity to T. Rowe Price, for example, they all start out with very high allocation to equities. Look at this, 90 to 95% allocation to stocks with 40 years to go to your retirement. That's incredibly high. I don't care how young you are. If you're almost 100% invested to stocks and you go down 50%, that is a shock to the system. Many people can't take this type of volatility. Maybe Warren Buffett can. In 2008, his Berkshire Hathaway was down over 50%, only to bounce back to negative 38% in 2008. But only professionals like Warren Buffett can do that. Most individuals should not be subjected to this kind of risk. And as you notice, as you approach retirement, say at the start of retirement, look at how these target date funds are allocated. You've got 59% at Fidelity still in stocks. I mean, this is unheard of. The lowest you have is Schwab, 40% allocation, which is a little bit more moderate in my opinion. But you should not be 40 to 45, 50%, 60% allocated to stocks at the start of your retirement. I think we can do better than most of these advisory programs. And we can do it alone, without an FA, without a Robo-Advisor, without a target date fund, and without having to pay extra fees. I've designed the WealthMax Builder investment portfolio for passive investors to rebalance once a year, set it and forget it. You can do this alone. You do not need a professional to do this. And as far as the monthly rebalancing during retirement, well then you can set up the WealthMax Builder program at Fidelity, where they have the automatic rebalancing program for you. So you do not need a financial advisor. The important thing is that you get the asset allocation right and make sure that it's a truly balanced, optimal mix of stocks and bonds. And that's what I show you in lessons 9 and 10 of the WealthMax Builder course, the Essentials of Investing course. Here's a quick review of the 3 passive investment portfolios that I talk about in the Essential of Investing course. The first is the all-weather portfolio from Professor Jones. Professor Jones wrote a textbook many years ago, and he came up with an all-weather portfolio that is supposed to ride you through good times and bad times. It's a very good asset allocation mix, which is why I included it in the book. However, it still has about a 45% weighting to stocks, which I find to be a bit excessive. The alternatives are the All Seasons portfolio. The All Seasons portfolio is Ray Dalio's asset allocation for passive investors. It was made public a couple of years ago and was discussed in a book written by Tony Robbins. This is a very good asset allocation as well and has a 30% allocation to equity funds. The WealthMax Builder program is my own passive asset allocation, which I designed before Ray Dalio made his All Seasons portfolio public. As you can see, the WealthMax Builder portfolio has outperformed Ray Dalio's portfolio since the 1980s, and it has a comparable composition to the All Seasons portfolio, but it has less of a weighting to commodities, which I think is important. I discuss how to implement the WealthMax Builder program in lessons 9 and 10 in greater detail. This table summarizes the real reward to risk returns from 1926 to 2017 for these 3 respective portfolios. Now, to go back to 1926, I had to essentially go with the overall weighting for stocks versus investment grade bonds versus commodities, if there are any, and extend that back to 1926. I did not have access to the funds that are available since the 80s and the 90s, for example, that are available in WealthMax Builder. So as you can see, the all-weather portfolio, Professor Jones's 45% weighting to stocks, beats All Seasons and WealthMax Builder by a little, but it also has higher volatility level and risk levels than WealthMax Builder or All Seasons. These returns are all after inflation has been taken out of the annual returns. So I subtracted CPI levels on an annual basis to evaluate the performances of these 3 asset allocations. The real profit factor then is simply the summation of all the up years in real terms after inflation divided by the summation of all the down years after inflation. So as you can see, the all-weather portfolio has a real profit factor of 3.92, followed by WealthMax Builder 3.82, and 3.63 for All Seasons. Well, that's all we have for this lesson 2 about financial advisors. I think that you can go this alone. I don't think you need to pay upwards of 75 basis points, 1% a year on top of the expense fees that are being charged for your mutual funds and ETFs inside your passive asset allocation. I think that just simply cuts more into your return. As we saw, you're foregoing over $200,000 in additional expense fees that are going to the financial advisor instead of into your own pocketbook. So that's it for this video lesson. I hope you enjoyed it. If you have any further questions, you can always shoot me an email or contact me via the contact information on the screen. Thank you very much. Look forward to seeing you in the next video.